Hello everyone, in this lecture we are going to discuss on the buy strategy. So for the buy strategy we have a couple of checkpoints, and if all the checkpoints are valid then we are going to take an entry. Okay, so the first checkpoint is we have to identify a valid edge formation. So if you look at this particular picture over here, image, there is a build up, a fine build up, a long build up over here, and the price, this particular red candle, crossed the low of the build up, and after that the price tried to cross the low or the high, anything should be fine. In this case the price tried to cross the low of the build up. The line over here that you can see, the blue line, is moving average, you can ignore that. But if you look at this particular build up, the long build up, the price moved down and crossed the low of the build up, and as a second step the price tried to cross the low of the build up. Even if the price try to cross the high of the build up, that's fine, no problem. Okay, this is called an edge formation. So once the price tries to cross and fails, this is called an edge formation. So this is the step 1. So if you look at this particular chart, this is the step 1. This is the high of the build up, this is the low of the build up, right? Price came up, it came down, and at this particular point the price tried to cross the low and the high of the build up, and this is where the first condition is satisfied, that is the edge formation. Okay, now what is the second step? The second step is look for a build up above the edge formation, which means if you look at this particular edge formation, right, this is a perfect edge formation, and here we have found or have seen a long build up above the edge formation. By above I mean by the, if the particular build up crosses the high of the edge formation, this is called above the edge formation, right? If I explain you on charts, let's say we have a edge formation like this, right? And if, so this is the high of the edge formation, high of the build up, this is the low of the build up. If the price goes up and again creates a build up like this, this is called, or this satisfied the checkpoint 2. Even if you see this kind of structure, let's say this kind of structure, this is the high, this is the low, even if the build up is formed over here but the breakout closes above the high of this particular edge formation, build up of the edge formation, this is also considered to be valid. Okay, so in this picture you can see there was another build up formed and our step 2 got valid. Now point number 3, look for an engulfing pattern. So we know what an engulfing pattern is. This is an engulfing pattern that we saw. This is step 1, this is step 2, and this is step 3. After all the steps, the 3 steps are valid, we are clear to take an entry. But before that we have to check one more check. We need to have one more check, that is moving average should be rising. That is step number 4. So if you look at this over here, if you look at this particular line, clearly the moving average is rising, right? So step 1, 2, 3, and this is step number 4, and now we are clear to take an entry, and over here we are going to take an entry after the close of this particular candle. We are going to discuss about stop loss and exits, don't worry, but for now I want you to discuss, I want you to focus on all the 5 steps. Scalping might look very easy, but if you incorporate all these 5 points, it's very difficult to find an entry, a perfect entry. And there are high chances that you make mistakes, or you don't take, let's say you might forget to take step 3 or step 4 into account. So I would like you to memorize all the steps for. So what is step 1? There has to be an edge formation. Now what is edge formation? A build up followed by the price crossing the low of the build up, and again the price trying to cross the low and the high, the low or the high of the build up. This is called an edge formation. After the edge formation, above the edge formation, there has to be another build up. Step number 2. As a step number 3, there has to be an engulfing pattern, a bullish engulfing pattern. As step number 4, while the bullish engulfing pattern is forming, the moving average should be rising. Now we have step 1, 2, 3, and 4 valid, and now we are clear for entry. We can take our entry on the buy side, which means either you can take, you can buy futures or you can buy options, right? So this is what the buy strategy is all about, right? So if you look at the today's chart, okay, today is 12th May, and if you take a look at the today's chart, this is a build up, a nice, sorry, this is a build up that was formed, right? And after that, the price went below the particular low of the build up, and the edge formation was not formed yet, but we could see another build up. This is very important. Watch it very closely. When we discussed about edge formation, I mentioned that we are going to consider only the fresh build up or a fresh edge formation, right? So before an edge formation was formed, we could see a new build up that was formed, and due to which we are going to consider only this particular build up, right? Now the price went up and tried to cross this particular point, which is the high and the low, right? So now we have our step 1 ready, which is we have an edge formation. Now step 2, above the edge formation, there has to be a build up. There has to be a build up. Nice, we saw a build up over here. Our step 1 and step 2 got fulfilled. This is step 1 and this is step 2. Now what is step 3? We should find an engulfing pattern. For that we have to put 20 moving average, and here we can see clearly over here there was an engulfing pattern, and we could have taken an entry over here, and we could have made a good profit, right? We'll discuss the exits and the stop loss, no need to worry, but this is all about the first entry, that is the buy strategy. Now coming to the sell strategy, there is a minor difference between the buy and sell, and these strategies are discussed and made after a lot of backtesting. So let's discuss the sell strategy. Now over here, the first step, the step 1, you have to look for an edge formation. You can ignore the part inverse, you'll get to know what I mean by inverse, but you have to look for an edge formation over here, same as step 1, right? There has to be build up followed by the price crossing or trying to cross the low of the build-up, and then again trying to cross the high or the low of the build-up. This is called an S formation. Coming to step 2, look for an engulfing pattern below the S formation. So if you take a look at the buy strategy, in step 2, we looked for another build-up above the H formation. But here, for a sell strategy, we're not going to look for that. We are directly going to look for an engulfing pattern below the H formation. So if you see over here, there is a build-up, the price came down, it tries to cross the low or the high of the build-up, the S formation, and then we could see there was an engulfing pattern, right? Step 3, moving average should be falling. Now if you can see over here, the moving average is strictly falling, right? And that's where we have an entry. Step 4. So on the buy strategy, we have 5 steps. The sell strategy, we have 4 steps. We do not count for the next build up in the sell strategy, because when selling comes, it's very fast, right? That's why we do not consider the sell, the build ups. And over here, you could have taken on entry, and this was on the expiry. And if you look at this move over here, you could have made twice or thrice the money. If you look at the charts over here, this was on Thursday, right? This is the screenshot that I'm talking about, right? An H formation followed by an engulfing pattern, and the moving average is falling, and the price moved at what time? 250. At 2:50 p.m. the price moved from 18,309 till 18,270, around 40 points, and 11 rupees premium, 18,300 C, sorry, 18,300 P for the 11th May expiry. It went from 11 rupees till 38, 39 rupees, which is more than 3 times. So this is the power of scalping, right? So we have discussed strategy 1 and strategy 2, which is a buy and a sell strategy. For this particular strategy, the stop loss is very easy, right? After you take an entry over here, your stop loss is above this particular engulfing pattern, right? And also in a buy strategy, your entry or your exit is just below this particular engulfing pattern. So exit is very simple. As soon as any candle closes below this engulfing pattern in a buy strategy, you're going to exit out of your positions. Okay, which means you will be having a stop loss of 4 to 5 points in Nifty and around 15 to 20 points in Bank Nifty. I'll show you over here in the charts. So if you've taken an entry over here around 18,309 levels, right? This is an engulfing pattern, and you could have taken an entry over here 18,309. So what should be your stop loss? Around 6 to 8 points on Nifty. So on Bank Nifty, the index price is higher, so you can count double the size of Nifty, which means around 18 to 20 points you should have. Okay, so the exit or the stop loss is very simple, but if your trade works, so over here you can see the trade worked, right? Or you can see in this particular entry, if you could have taken an entry over here, the trade worked. Now you might be wondering, where should be your exit? Okay, so in this lecture we're going to discuss on exits as well. Exits are not very simple, right? So exits are an art. So the first rule of exit is, if you make at least 10% of your capital, you can exit out of your positions. Second, if you make 10% of your capital, you can partial exit, which means let's say you have taken 1000 quantities. Out of the 1000 quantities, you can maybe exit 500 quantities, and you can keep the rest of the quantities to make more profits. Okay. This is the first rule. Now the second rule is exit only when there is another edge formation. Now what it means, whenever there is an edge formation in a market, let's say you have taken an entry over here and there is a edge formation over here, right? And this is a edge formation. The price came down and it tried to move up, right? This is an edge formation like this, and you have to mark the low and the high of the build up. Now after the edge formation is formed, you have to look for a build up above this particular point, to have your step 3 to take one more entry on the buy side if there is an engulfing pattern, or you have to wait for the price to fall down. So as an exit strategy, if there is any edge formation, you can exit out of your position, or exit only when there is an edge formation plus a sell strategy, which means you are going to get out of your buy position with the remaining profit, and you have to enter into a short position. This takes time and experience, but this is a very good strategy to count on, and you can maximize maximum profits with this particular strategy. Okay, so these are the 2 points that you can remember for exits. In the next lecture, we're going to discuss on position sizing.